only one who ran away to Miami.
Yeah.
Was as one of the only sort of 10 Irishmen called Evers, I will kick off this session and welcome everybody to the Daily Energy Markets podcast. It is February 2nd and oil prices have taken a little bit of a hit yesterday. Brent crude trading this morning 83.38. Rising in early trade in Asia today, and WTI well below 80 now, at $77 a barrel. Yesterday there was a number of events that took place, but in some ways, while the Fed and others financial assets were celebrating the announcements yesterday, it seemed the oil markets were uninterested. Let's kick off this morning in the US, in Florida, with Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Mike, no surprises yesterday from the Fed announcement. Anything in the weeds, anything in the press conference afterwards that give us something to look at going forward?
Not at all. I do enjoy the discourse of people trying to make things out of little sayings and things. The simple fact is the Fed has tightened. They're still tightening. Chairman Powell's hawkish. The economy is tilting towards recession, and they're still tightening. And I think things like crude oil picked up on that. Copper's bounced a little bit this year, but if you look like on a 12-month basis, copper and crude oil is still down quite a bit. Crude oil is down about 12%, copper is down about 7%. I think that's the market all tilting towards, we see the economy heading towards recession. Things are slowing down significantly. The Fed is still tightening, fighting inflation, which is also absolutely plunging. So to me, that's the macro. It's trying to make nuances out of the statement. And Chairman Powell's key thing is they will not be easing this year. That's a statement to make, but I think the market's going to force them to. And that's the key dichotomy right now. Markets are priced for easing later in the year. Chairman Powell says they won't, but markets will force them. And you can see that what's happening in crude oil and natural gas. They're already kind of indicating that we're heading towards significant deflationary periods. I'll end with this. The US benchmark natural gas, the primary source for energy, electricity in this country, has dropped to the same price that was first traded in 1995.
Well, there's some historical context. Let's welcome Kieran Gallagher, Managing Director of Vitol Bahrain. Kieran, a lot of, as I said in my intro, financial markets in general, the equity, the risk-on assets have enjoyed a bumper January. And again, after the Fed announcement yesterday, a big pop-up in equity markets, but oil prices declined. Why is oil uninterested in this optimistic mood we're seeing in all other markets?
Yes, good morning, Sean. I think basically I think a lot of the crude move yesterday was led by products. You know, the stocks are healthy. Demand in Europe is pretty stable, and we're not. It's a fairly uninteresting market. There's a lot happening in the next few weeks that could obviously change that, but largely, we're still seeing healthy supply. And despite the onshore stocks in the US having obviously drawn through the SPR releases over the last sort of nine months or so, and I don't think that's what the weekly crude stocks on a Wednesday afternoon. I'm not sure that's where people are largely looking to in terms of their next direction. This is what we see at the moment is quite largely product-driven market, and at the moment we're seeing a good degree of stability there.
Let's welcome James McCallum, CEO and Chairman of Exergy Group, Professor of Energy at Strathclyde University. There is tightness in this market a little bit on the supply side, James. A surprising announcement, a new data point overnight from the US, with US oil production declining in January. We're not seeing that US oil production, unlike other countries, other producing countries that are back to pre-COVID levels. The US continues to struggle to get oil production up. You've watched that space closely. Why are we not seeing that?
There are several reasons there, and I would just pick you up. I think there was quite widespread coverage yesterday that, in actual fact, a couple of the other major producing areas of the world, Iraq, Nigeria, also not able to pick up their production. One of the points I've steadily made, Sean, is that there is a real bottleneck in terms of the service sector's ability to provide the equipment to actually do anything around massive increases in new wells, et cetera, and that's borne out. I mean, we saw a decline in the Baker Hughes rig index, albeit a small one, but at the end of the day, a significant one. Rystad, in one of your articles, are reporting on relatively positive news for service companies going forward over the course of the next 5 to 6 years. But when you drill down into the data, you'll see that it's still well below the highs of 2014, which, give the listeners some context there. Baker Hughes rig index in the United States at about 600 of a count just now. That would have been 1,500-1,600 in 2014. And to be honest, I always like to try and take a note of positivity, to the markets, especially when I want to put a little counter to Mike, when Mike and I are on together. But the reality is that it's very thin. The sort of news that's out there is very, very thin. And I think Mike touched on the fact that the market's trying to hold on to anything. And I thought he was going to kick on to talk about a word which I hadn't heard before until yesterday, which disinflation seemed to be a word that had leaked out and was picked up on by the markets. But no, there's not a lot there. Service sectors, companies, Schlumberger, Halliburton, SOX, all down, not following the rise yesterday. So the truth of the matter is that the oil services sector market doesn't believe there's going to be a very significant upturn anytime soon, and the share prices and the equity prices of all the players are reflecting that across the OSX index.
Mike, one of the reasons given, sort of reported at least yesterday in the oil price decline was due to U.S. inventory builds, a big build, 4 million plus barrels. Where is the outlook for that as we go towards the long overdue refining maintenance season, which could be quite a significant one, given that we've sort of delayed a lot of maintenance in the refining space?
Well, one thing I enjoyed pointing out about 6 months ago when people pointed out how low inventories were was, well, that's typically when the market prices make peaks and inventories are low, and then it's the opposite. And the key thing I like to point out, it's not so much, it's obviously we talked about supply, it's been a little bit of a laggard, but it's demand destruction that's quite significant. It's accelerating and is heading lower, is the actual demand. That's the key thing we pointed out back in June when U.S. implied gasoline demand, the primary source of demand for petroleum in this country, peaked in June. And it's dropping at a higher velocity than 2008. And for obvious reasons, it's just pure supply and demand elasticity from the price spikes. Now, prices have dropped, but that's the key thing I like to point out is the supply side is coming back on more slowly as a lag to higher prices, but it's demand that's dropping very hard, particularly in this country. And it's just so logical. It's one thing you can see on any type of mathematical model. You can always see that demand destruction when you have prices spike as much as they did. So that's what's been my focus, and what Chairman Powell focused on disinflation is what I've been pointing out in commodities forever. And I did have to correct myself. Now that natural gas has dropped so much, this price in the screen in the US was first traded in 1990. And it's just the autocorrelation factor of commodities, because we absolutely just use less of it, can create more of it, and the elasticity is increasing. So I like to focus on that aspect of it. And it's the macro that really matters in commodities and crude oil right now. And that's Fed tightening into a recession. And then also I like to point out, I think that's really changed in the last few years because since the crisis and the financial crisis, is things like crude oil commodities, most notably crude oil, have a higher correlation now to the stock market than to supply, demand, and inventories.
Kieran, yesterday, of course, we also had the OPEC Plus meeting in which they decided to do nothing essentially and leave in place their current output policy, which was the 2 million barrel a day quota cut from the fourth quarter last year. They're holding on to that policy, while in January, actual crude production supply out of OPEC Plus did decline. And so their numbers below their production ceiling, i.e. 1 million plus a day. But essentially the markets paid no attention. Is OPEC plus irrelevant right now, even with the reopening of China?
No, I wouldn't say they're irrelevant in any shape or form. I think there was a view going into that meeting that why rock the boat? You know, there was the Fed were announcing on the same day, obviously. We've got new price cap regulations coming on February the 5th. We're still in that sort of post-Chinese New Year COVID recovery element in China. So there is that little bit of uncertainty at the moment that, you know, should OPEC have gone up or down? You know, there's a lot of other things happening in the world at the moment. And, you know, with relative stability and albeit mild backwardation, I think, you know, the general consensus will why now? Why change anything now? And I think that was evident, you know, the day before yesterday, there was a sort of cancellation of the pre-meeting. And I think it was, you know, there's probably nothing to see here. So I think that, you know, it was an unchanged view by OPEC Plus, I think was largely priced into the market.
James, we're sitting in Europe. You're sitting in Europe, I should say. But with the fast approaching the first anniversary of the Russia's invasion of Ukraine, and reports overnight by the Ukrainian defense minister that the Russians are building a force of 500,000 soldiers. Last year it was 200,000 on the eve, and people were like, oh no, they're never going to do it. Now there's 500,000, and are we sleepwalking into a major escalation here in which the risk-on markets are completely disregarding?
Yeah, look, you raise an incredibly important point, Sean, and I know one of your recurring sort of themes to the speakers is what's the black swan event of 2023? I mean, clearly the Russia-Ukraine situation has to be a potential black swan event, and amazingly, you know, for me, the markets are completely ignoring it, but it's definitely, as you quite rightly point out, not going away. It's escalating in terms of the severity of the numbers that are there. It's escalating in terms of the kind of equipment that's being put onto the ground by the allies of the Ukraine. And I think it's a very brave person that says this will stay in the background over this coming year. For me, you know, I think it is trickling up, and I think it's an extremely concerning development that's going on there, because I think Putin is entirely unpredictable. So I can't ignore that as, for me, the big event that could come in quite literally from the cold in 2023 and have a real shudder across the world, and that will flow into the market. So yeah, I think it's good. It would be right to be cautious about that, because it's certainly not going away, as people frequently say, and it's definitely looking like it's heading into a new period of escalation.
Mike, on that point, and taking up the sort of broader commodity profile, are we seeing that stress appear in any other of the commodity markets? Clearly, one of the biggest issues for Ukraine and an escalation of conflict there over the last year has been around the export of grains. Are we seeing the stress reflected anywhere else with this potential escalation, or are all commodity markets a little bit subdued?
Yeah, it's a good point. The primary commodity that really matters in that space is corn and wheat. And corn is the most significant commodity that's still up about 10% on a 12-month basis. I view that as the war premium still in the market. It's been fading rapidly. The forward curve, corn right now in the front contracts around 7, forward for the end of the year is closer to 5. I fully believe that. That supply is coming on fast. South America's got a little a weather issue, but that corn's going to come on really big. I'm from there, and man, when you can make that kind of money, that price, that supply will come. It's always the way it is. The key thing about the war is it looks like we're heading towards a pretty significant stalemate. I mean, both sides are kind of maybe end up like North and South Korea, and the market seems to be pricing for that. So to me, the major shoe to drop, unless there's a major escalation, is corn's going to drop from 7 to 5. and is going to follow some of the rest of the commodities. One key indicator is natural gas. Natural gas is a primary feed for corn fertilizer and hydrous, and natural gas, as I mentioned, is just plunged. So to me, that's a major shoe to drop in commodities. The forward curve is somewhat priced for it. I think the risk is it drops more than expected. And then, of course, there's not much I can predict out of a potential war, but I think we're stalemate. Most markets get that, and that invasion is just failed.
Well, let's see where that goes. I mean, it's surprising in some regards that, as James referenced, that the Black Swan event could be a major escalation of the war in Europe, when it seems to me the brightest white swan of obvious that it could ever possibly be. But Kieran, looking at the other sort of, as you say, there's still shoes to fall here in the coming weeks and months. The big one coming this week is the EU embargo on Russian oil products. And I wanted to get your thoughts on the outlook and impact that will have, and sort of intersecting that with the sort of declining refinery margins and the growing amount of Chinese refined products that have come into the markets in recent months. I wonder if you'd sort of connect those things together for us.
Well, I guess when you talk about declining refinery margins, Sean, remember they're coming off quite incredible highs. So refineries are still making healthy margins.
We won't be passing the hat around for refiners just yet.
No, certainly not. But yeah, you would. The devil's in the detail when it comes to the price cap regulation that's going to come in on February the 5th, and there's quite a lot of uncertainty there. There's still a huge need for clarification on there's this rumored $100 a barrel on diesel, but from the EU side, not necessarily with G7 agreement. And within that, then there's a lack of clarity on whether the different grades, the straight run versus cracked fuel, high sulfur versus low sulfur diesel, where all these fall. So I think there's a lot of sort of sitting on the sidelines by the market at the moment in terms of waiting to see how that plays out. And I think you've sort of seen that in the price action over the last couple of weeks as well. So I think next week we could see a period of volatility when there's a little bit more clarity over that. I think when you talk about increased exports out of China, I do tend to agree. I think there was quite low gasoline exports in around second half January and first half February, again around Chinese New Year. But then we are seeing a big tick up in the jet fuel demand in China, and would expect to see more of that. So I think in terms of how this plays out. Certainly from the shipping programs, etc., it does look like because of Chinese export margins, we will see a healthier program second half February into March from China. But then there's this wait and see how does the recovery continue. If it continues apace, then you ought to see some better domestic gas oil and MoGas numbers, and therefore those exports naturally slow down.
James, on the same point, obviously Europe seems to have got through the winter without an energy crisis. We're seeing across all energy supplies, obviously natural gas most significantly coming dramatically down. And now with the embargo on oil products coming this week, it looks like Europe is relatively nonchalant about these developments. Should they be?
I think yes. I mean, the reality is that what's happening in that space is that nobody quite believes it will have a massive impact on product supply, diesel supply, in terms of the European ability to sort of put fuel into the garages and into people's cars, and you're seeing that reflected in the price at the pump. If anything, it sort of like nudges up a couple of points, down a couple of points. Week on week, nobody's really thinking there's going to be much of a change, just as there wasn't with the oil embargo. And I think Kieran, hits the nail right on the head. There is this just incredible sense of fence sitting right across the board as everybody kind of waits for some kind of a leading indicator that tells us things are going to be much, much better out of China, but nobody's quite sure. Europe's kind of dodged the bullet on the energy crisis, but nobody's actually quite sure we won't get some snow in March and April. But the one thing that is out there that hasn't come into the conversation today is but let's remember there is an incredible amount of liquidity in terms of cash out there which wants a place to invest, and that is what has seen us steadily see just little jumps in the market. I'm sure Mike will have a comment on this, but that's what's kind of driven that little steady wave of the markets up, because there is a lot of money out there that wants to find a home, and it's looking for any kind of positivity to say, I'm in. But ultimately, right across the board, I think it's hard to have looked at this first month of the year and not think big energy companies sitting on the fence and not investing into new infrastructure, supply demand kind of going nowhere, China kind of lots of optimism but not going anywhere.
Mike, just pick up on that point, because it does seem to be, I mean, the Europe is, if there's a surprise of the last year, the fact that the European Union has not gone into recession yet. And the latest forecast in the IMF is that it'll avoid recession, with only the UK now forecast to go into recession. Is this stimulus money, the savings from the COVID period, where apparently the US was up to $3 trillion of personal savings from non-spend, with on top of that, of course, the government stimulus across the OECD countries, and now China emerging from COVID lockdowns with $2 to $3 trillion of savings ready to spend, that wave is just trumping any other downward pressure on markets?
Long and variable lag is the key thing to remember about central bank interest rate policies. And the fact that a year ago, the US federal funds rate was 0, is almost 5% now, still rising as the global economy declines, most notably US, is early days. And anybody who's long risk assets, a year ago, the theme was don't fight the Fed. The theme right now is still don't fight the Fed. Anybody who's buying risk assets, I think, is making a major mistake and should be buying US treasuries. You can get almost guaranteed you're going to get 9% in that 2-year note over the next 2 years. And that's what the Fed's telling you to do. And that's what I'm sensing here is most people are buying dips in treasuries. And only the few speculators are still left in the stock market. And most people, I suspect, if you bought into that January hopium, I say good luck. I think we're in the midst of the biggest global macroeconomic reset of our lifetimes. And that means risk assets go down. Following commodities are a good indicator. And yes, there's cash. There's always a lot of cash. I remember hearing that in 2007. But this case is you're fighting the Fed. The key point I like to point out about the last financial crisis is the Fed started easing in September 2007. The market did not bottom in terms of equities until March of 2009. And so typically the Fed has to start easing, and commodity markets typically bottom a year and a half after the first ease. And we're still tightening. So the macro is very unfavorable, and you got to be very careful trading the nuances within the trends. The trends are don't fight the Fed. And stock market's probably in a bear market.
Well, it seems like a lot of people are fighting the Fed at the moment. They just don't believe they're going to hold the line. Let's get the survey question, which we've sort of been bouncing around a little bit on in our discussions. Why is oil market not participating in 2023 rally across financial markets, at least thus far? Supply exceeds demand, negative global economic outlook, although the IMF did revise upwards their growth for the global economy earlier this week. It was just a marginal revision up. China, despite all the noise, is still not open. So why ultimately is the oil markets not following? Kieran, I wanted to get your views. I mean, there's a lot of talk in the last few days about the oil products price cap, but the crude oil price cap that came in early December with the embargo on Russian marine-bound crude, would it one have to now, 2 months later, give it a sort of tick of success, that it was achieved its objective? Russian crude oil is substantially low, obviously well below the global benchmarks, below 60, and oil is still flowing everywhere it needs to go to. Would you say it was a success from its intention?
Yeah, I think evidence is there that it was a success. The oil has continued to flow, as you say. It's found its way into the homes that EU and G7 wanted it to find into, and sort of envisaged it finding its way into, like India and China, etc. And refineries continue to run, so they seem to have hit the right point for that price cap. And I guess so. The challenge is, can they do the same in a few days' time on the products? But yeah, I think it's quite obvious that the market is pricing in a way that it doesn't see a shortage of that crude supply from Russia at all.
But just, Kieran, to follow up on that, it's also given wind of the sails of the sort of dark tanker market, ship to ship trading on the open seas. How big and how distorting is that for the sort of proper market, if you like, the regulated market?
I think there's incredible volatility in the shipping markets, and you don't need much of an event for a spike in clean or dirty rates at the moment. We're seeing it in this region in particular. But I think the STS is more around logistics, because that fleet of privately owned vessels, is limited. It's growing. It's quite difficult to put a number on it, but we do see sales ongoing, and it's probably going into that particular fleet and for those particular ports. But then remember, Sean, a lot of these ports are it could be draft restricted, deadweight restricted, etc., like that. So a lot of the ship-to-ship operations are happening because you've got smaller ships that need to load, and then they're going and ship-to-shipping onto the larger ships. So I'm not sure this sort of all the headlines about what's happening at sea is related to something dark forces at work, shall we say? There's some logistics enforced ship-to-ship operations happening also.
James, the year just passed, and as we go into 23 now, month 2, last year we saw very much energy security come and kind of kick the sand into energy transition, which had sort of come out strong after Glasgow COP. Where do you see things now moving forward? Europe abandoning its energy transition or doubling down in the transition and renewable space? There was an incredible headline, today, where 100 million jobs to be created in renewable energy by 2030.
Yeah, look, I think the politicians are part of the mix on this sitting on the fence piece. Energy security has been the prominent sort of theme for the last year, and I think it will be into the summer. Again, politicians desperate to get into that energy transition space because it wins votes, quite frankly. And I think the fact that we've got US production not really going anywhere, the big super majors not investing into traditional hydrocarbon infrastructure, the service sector not investing into new equipment supplies to enable it to do that. I think, as I said, there's a good article from Rystad on the Press Digest today for listeners to take a look at, which really just sort of explains very clearly why the service companies are unable to sort of press ahead with new equipment supplies, et cetera. The politicians will get back into that energy transition just as soon as they can, but I don't really see that conversation happening in any particularly strong way, through to the summer. The thing I will say, Sean, which is going unnoticed, is that there is this view within Europe that the energy transition will simply be a sort of a compounding initiative where everybody eventually kind of gets all back into renewables at exactly the same time. And that is a complete fallacy. If you just simply look at offshore wind, and if you like, the ScotWind offshore licensing round in the UK, biggest in the world, forecasting sort of 30 gigawatts of power supply. it is not it is not a sort of an investment sphere where you can have parallel large offshore wind farms going in at exactly the same time. The supply chain for renewables is just not geared up to do that. So it's going to be a much slower transition than many people actually think, and we're going to have to continue to manage and navigate the energy supply issue carefully. I think, in one final word, I think Kieran has made the statement of the day around how the world is dealing with oil supply, and when he sort of says it's finding its way. That's a lovely way to sort of ignore the sort of like turning a blind eye aspects to the embargo. Is finding its way, Kieran. I love that.
It's a Donegal saying. Let's get the survey result and give Mike the last word about supply exceeds demand. Seems to be the clearly obvious one in terms of no stress in the oil markets at the moment. In the theme of all things Irish, and it's not even St. Patrick's Day, but two Irishmen met in the White House yesterday to lay down the path towards perhaps the biggest shillelagh fight they're going to have this year over the US debt ceiling, McCarthy and Biden. Is this, Mike, do you think, a space to keep an eye on? Is it more serious than it has been in before? This time it's really serious, is kind of seems to be the narrative, when really at the end of the day it ends up resolving itself. Your thoughts with a dollar hitting a 9-month low today, where this debt ceiling issue is, and should we be watching?
Hopefully not. It's supposed to be just solved. There's only one solution, as Chairman Powell says when he was asked, and they will come to that solution. It's just political posturing. Most people here are sick of hearing it, but it's inconceivable. And just let's chalk up and raise the number and move on. Just a matter of time, and that's what's going to happen.
Well, on that note, we will wrap it up and close out the session on February 2nd. And thank Kieran Gallagher for joining us from Vitol, Bahrain, Mike McGlone from Bloomberg Intelligence in Florida, and of course, James McCallum, who seems to have dropped in a hole in Blessington. I'm not sure where he's gone. But James, thank you very much. We look forward to catching up with everybody. As I said at the top of the show, oil is trading Brent above $83, but a significant drop yesterday. It stays, or Brent, in that sort of 85 minus $1 or $2, or 85 plus $1 or $2 seems to be the barnacle on a rock so far this year. Hard to see anything moving it from there, at least on the immediate horizon. Thank you very much. All the best.